Let's have a look at learning objective number 5, which looks at the cash flow statement. So the cash flow statement covers exactly that, cash flow. So we're going to look at what exactly is covered in the cash flow statement. Now, previously, as I said, we looked at profit in the income statement, which relates to when we earn revenues and when we incur expenses, which can be different from cash flow timing. And this is an issue we're going to talk about in more detail in the coming weeks of the subject. However, even though we're interested in profit in the income statement, that doesn't mean we're not interested in cash flow. Cash flow is an absolutely critical part of our business, because if businesses don't have sufficient cash flow, then they will go out of business very quickly, because they simply will not be able to service their liability obligations as well as their ongoing expenditures, which are necessary to keep those organizations running. So as part of the cash flow statement, we look at where a business gets its cash, where it goes, and therefore what it's left with, and whether or not we have any concerns relating to the cash position of an organization. Okay, so there are 3 main sections that we look at in a cash flow statement. The first section is the operating activity section, which is the everyday cash flows associated with the business. So these are the cash flows associated with the normal everyday activities of the business. Buying inventory, paying employees, receiving cash for the generation of sales revenue, provision of services, payment from customers, etc. These are all captured as part of operating activities. Investing activities relates to cash flow related to investing in the productive capacity of a business, right? So acquiring long-term assets, divesting long-term assets. These are all investment-related activities. Financing, again, as the name suggests, is related to financing the operations, borrowing cash, paying cash back, servicing the loan obligations of the business. These are all financing related cash flows. Okay, so if we look at an example of a cash flow statement, this captures the movement of cash over 1 month. So for the month ending 31 January 2018, you can see here that the business had substantial flows of cash, right? So they received cash from owners, paid for different things. So the things in brackets are outflows. The things not in brackets are inflows of cash. So in accounting, we generally do not use negative symbols. We put things that are outflows or that are losses or that are negative numbers in brackets. So that's an important thing to note at this stage of the course. Okay, so they invested in buying a new lawnmower, a petrol can, which is an asset which helps them generate future profit. So that's an investment. And then we look at the net cash used by investing, which was the sum of the lawnmower plus a petrol can, which is a $280 outflow. We had financing, which was cash received from borrowing, cash received from the owner. We then had distributions to the owner, and we had net cash used by financing activities. So therefore, we had an increase in cash related to financing of $194. Okay, so we started with cash of 0 on the 1st of January and ended with $194 of cash at the end of the month. Okay, so a very important statement. We need to look at where our cash is coming and going from, and so we have an idea of the stability of the business and whether or not it can remain in business. Okay, a question for you is, a Telstra store purchased a demonstration iPhone 8. I know that's an old iPhone now, but anyway, let's go along with the example from Apple Corporation. This phone is optimized for store display. All right, so it's one of the phones they put in the display area where you can pick up, that's connected with that cable, and you can use it and look at it and test out some of the different functions. So the cash flow associated with this purchase would be included in which part of the cash flow statement? Operating, investing, or financing? Which one do you think? Well, the answer in this case is investing, because this phone is not one that's sold to customers. It's one that's used as display. It is one that is used to generate future profit, right? So they are investing in an asset to allow the business to generate a higher degree of profit in the future. All right, it's not operating because it's not a normal piece of inventory they acquire and they simply resell unchanged to the customer. It's not financing because it has nothing to do with borrowing money or raising funds as part of the business's activities. It is investing in an asset to generate profit. So investing is the best answer in this case.